Hi all, I am Gowri. Today I am presenting about the topic capital rationing. What is capital rationing? The capital rationing is a situation where a firm has limited fund or capital and cannot invest in all profitable projects. That means the firm must have select the best combination of project that gives the maximum return within the available budget. That means if the firm must have only rupees 1 lakh rupees and they need they and the best and they want to buy the best project, then at least they require 3 lakh rupees. So they have not initial they do not have that much capital, so they choose the best, so they choose wisely. That means choosing the best project among them. That is capital rationing. Here also it is that capital rationing occurs when a firm has limited funds available for the investment and cannot undertake all profitable projects. The firm must therefore select only the most value creating opportunities within its budget constraints. Now let us discuss about the types of capital rationing. There are two types of capital rationing: hard capital rationing and soft capital rationing. In hard capital rationing, it is caused by the external factors and the firm cannot raise fund out from the outside sources, and for example it is finding difficulty in getting loans from banks, and high interest rates and poor economic conditions are the examples. It is beyond the control of the firm. That means it is not under the control of the firm. And the next is soft capital rationing. It is under it. It is caused by the internal management decisions. That is, it is caused by the internal decisions of the management, and the firm itself limits the amount of investment. For example, fixing a minimum budget, avoiding risky investments, maintaining control of the company, etc. And this is under the control of the firm. Hard capital rationing is not under the control of the firm, and soft capital rationing is under the control of the firm. And why does capital rationing occur? That means the reason for the capital rationing is, the first one is limited availability of funds. That means the firm may not have enough internal funds, so it may find difficult to raise the external funds. And high cost of capital. That means borrowing money may be expensive for the firm due to the high interest rate, reducing profit, etc. Risk and uncertainty. That means future returns are uncertain. That means so firm avoid investing in too many risky projects. And control considerations. This means raising new funds may be reduce the ownership control, so the firms limit the investments. Next, we are discussing about the methods of capital rationing. There are four methods in capital rationing. First one is profitability index, net present value, internal rate of return, and linear programming. First one is profitability index. Profitability methods. That means PI method. It measures the return per rupee invested. That means it measures the return per rupee invested. The formula for finding the profitability index is present value of cash inflows divided by initial investments. Higher PI projects are selected first. And second one is net present value or NPV method. It measures the total profit. It measures the total profit in present value terms. It means project with higher NPVs are preferred, and it helps in selecting the best combination of the projects. And the third one is internal rate of return. That means IRR method. It shows the percentage of the return of a project. That means the projects with higher IRR are selected. And the last one is linear programming. It is a mathematical method used when many projects are available. It helps in selecting the best combination under the limited funds. Next one is project selection. Under capital rationing, Even the funds are limited, firms follow a systematic process. That means first one is identifying all the available investment projects and estimate the cost and returns of the project and rank a project using the PI, NPV or IRR methods and selecting the projects within the available budget. And finally, chooses the combination that gives the maximum total profit. Situations in a project selection. Single period capital rationing. In this, budget is limited for one period, that is usually for 1 year. The budget is limited for one period and here the selection is simple using the ranking method. And multi-period capital rationing. In multi-period capital rationing, budget constraints exist for several years. In single period capital rationing, it is for a one-time period only, and here it is for multiple future years. And more complex decision making is required. Here requires a more complex decision making. And here and in the single period capital rationing, the selection is simple, that is using the selection is using the ranking methods. Another is divisible and indivisible projects. In divisible projects, investments can be made partially, and the firm can invest in parts of different projects. And in indivisible project, the project must be accepted or rejected in full. That means project must be accepted or rejected fully, and it requires careful selection of the best combination. And let's conclude with that. Capital rationing is an important concept in the financial management. It helps the firms to use limited fund efficiently by selecting the most profitable projects. The proper use of methods like NPV, PI and IRR ensures better decision making and maximum returns.